Welcome back to the channel. Everyone, today, we're diving into something that might sound complicated, but I promise, by the end of this video, you'll feel like a pro. We're talking about economic indicators, those powerful numbers that can help you understand the health of the economy and even anticipate where the market might be heading next. Think of it like learning to read the weather forecast, but for your finances. It's an essential skill for anyone serious about investing, and I'm going to break it all down for you, step by step. So, grab a coffee, get comfortable, and let's unlock the secrets the market is telling us. First up, the big one, Gross Domestic Product, or GDP. You've definitely heard this on the news. Simply put, GDP is the total value of everything a country produces and sells over a specific period. It's the ultimate report card for a country's economic health. When GDP is growing, it means the economy is expanding. Companies are making more, people are spending more, and businesses are hiring. For investors, a rising GDP is generally a green light. It suggests corporate profits will be strong, which can push stock prices higher. On the flip side, if GDP starts to shrink for 2 consecutive quarters, that's what we call a recession. This is a red flag, signaling that companies might struggle and the market could go down. So, when you see those quarterly GDP reports, pay close attention. It's the broadest and most powerful indicator of the economic landscape you're investing in. Next, let's talk about jobs, specifically the monthly jobs report, which includes the unemployment rate. This indicator is crucial because it tells us how many people are employed and actively looking for work. A low unemployment rate is fantastic news. It means most people who want a job have one. This leads to higher consumer spending because more people have a steady income. Think about it. When people feel secure in their jobs, they're more likely to buy a new car, renovate their home, or go on vacation. This spending directly fuels company profits. Conversely, a rising unemployment rate can be a warning sign. It suggests the economy is slowing down, and people are cutting back on spending. This can hurt businesses and, in turn, the stock market. So, watching the jobs report gives you a real-time pulse on consumer confidence and spending power. Now, let's tackle a topic that affects every single one of us, inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. The most common measure of this is the Consumer Price Index, or CPI. The CPI tracks the average change in prices paid by consumers for a basket of goods, from gasoline and groceries to clothing and rent. A little bit of inflation, say around 2%, is actually considered healthy for a growing economy. But when inflation gets too high, it's a problem. It erodes the value of your money and can force the central bank, like the Federal Reserve in the US, to take action. This brings us to our next key indicator, interest rates. Central banks use interest rates as their primary tool to manage the economy. When inflation is too high, they raise interest rates. This makes borrowing money more expensive for both consumers and businesses. Mortgages, car loans, and credit card rates all go up. This is done intentionally to cool down spending and bring inflation back under control. For the stock market, rising interest rates are often seen as a negative. Higher borrowing costs can squeeze company profits, and it makes less risky investments, like government bonds, more attractive compared to stocks. On the other hand, when the economy is weak, central banks will lower interest rates to encourage borrowing and spending, which can stimulate economic growth and often gives the stock market a boost. So, always keep an eye on what the central bank is saying and doing about interest rates. Let's move from the broad economy to the mood of the people with consumer confidence. This is a survey-based indicator that measures how optimistic or pessimistic consumers are about their financial situation and the overall economy. Why does this matter? Because consumer spending is a massive driver of economic activity in many countries, It accounts for over 2/3 of GDP. When consumer confidence is high, people are more willing to make large purchases, take on debt, and invest their money. This creates a positive cycle that benefits businesses and the stock market. When confidence is low, people tend to save more and spend less, which can slow the economy down. So, consumer confidence acts as a fantastic leading indicator, giving you a glimpse into future spending habits before they show up in the hard sales data. Another important area to watch is the housing market. Indicators like new home sales, building permits, and housing starts tell us a lot about the health of the economy. Think of all the economic activity that surrounds the construction of a new house: lumber, concrete, appliances, furniture, landscaping, and all the jobs associated with them. A booming housing market has a powerful ripple effect across the entire economy. It shows that people are confident enough to make the biggest purchase of their lives. A slowdown in housing, on the other hand, can be an early warning that economic trouble is on the horizon. Fewer building permits and housing starts can signal a drop in consumer demand and a potential economic contraction. Now, let's talk about the business side of things with the Purchasing Managers' Index, or PMI. This is a really interesting one. The PMI is a survey of purchasing managers at hundreds of companies in the manufacturing and services sectors. It asks them about things like new orders, production levels, and employment. The final PMI number is a score from 0 to 100. A reading above 50 indicates that the sector is expanding, while a reading below 50 indicates that it's contracting. The reason the PMI is so valuable is that purchasing managers are on the front lines of the economy. They have to anticipate future demand to know how much raw material to order. This makes the PMI an excellent leading indicator of economic activity. If businesses are ramping up orders and production, it's a strong sign that they expect the economy to grow. So, how do we put all of this together? It's crucial to understand that no single indicator tells the whole story. The real power comes from looking at them collectively, like assembling the pieces of a puzzle. For example, if you see GDP growing, unemployment falling, and consumer confidence rising, that's a very strong signal of a healthy, expanding economy. That's a great environment for stocks. However, if you see inflation starting to spike and hear whispers that the central bank might raise interest rates, that could be a sign to be more cautious, even if the other indicators are still positive. Let's walk through a hypothetical scenario. Imagine the jobs report comes out strong, showing more people are employed than expected. That's good. But then, the PMI report comes out and it's below 50, indicating the manufacturing sector is contracting. And on top of that, new home sales have dropped for the third month in a row. See, it's a mixed picture. The strong jobs report might reflect past strength, while the PMI and housing data could be pointing to future weakness. By analyzing these indicators together, you get a much more nuanced and accurate view of the economy than you would by looking at just one. It's this multifaceted approach that separates savvy investors from the rest. Learning to interpret these indicators is a skill that takes time to develop, but it's incredibly rewarding. It allows you to move beyond simply reacting to market noise and start making informed, proactive decisions. You begin to understand the why behind market movements. You see a stock market rally and know it might be because of a positive inflation report that suggests the central bank won't have to raise interest rates. Or you see a dip and understand it could be linked to a weak PMI report that has investors worried about future growth. This knowledge empowers you to stay calm during periods of volatility and make decisions based on data and logic, not fear or hype. It transforms you from a passive spectator into an active, intelligent participant in the market. Thank you so much for sticking with me through all of that. I know it was a lot of information, but understanding these key economic indicators is truly a game changer for any investor. I hope you found this breakdown helpful and feel more confident about reading the financial weather. If you enjoyed this video and learned something new, please give it a thumbs up. It really helps the channel out. And if you haven't already, make sure to hit that subscribe button and ring the bell so you don't miss our future content. We've got plenty more to explore together. Thanks again for watching, and I'll see you in the next video.